All right, so a new company is about to hit the stock market. How do you figure out if it's a golden opportunity or maybe just a house of cards waiting to tumble? Well, today we're going to tear down the IPO of a beauty brand called RAVELCARE. The goal here is to give you a framework, a mental toolkit for analyzing any company going public by looking at the story, the numbers, and, of course, the risks they don't always advertise. And really, this is the big question, isn't it? Is this the next unicorn, or is it just a flash in the pan? Now, let me be super clear. Our goal today is not to give you stock advice on RAVELCARE. Nope. It's to walk you through a process, a way of thinking that you can apply to pretty much any IPO you see.
Okay, so here's the game plan for today. First up, we're going to meet RAVELCARE and see what they're all about. Then we'll dive into the bull case, the shiny, exciting story they want investors to hear. After that, though, we're going to flip the script and look at the bear case to find those hidden risks. And to wrap it up, we'll figure out where all that IPO money is actually going. Let's do it.
So first things first, who is RAVELCARE? Well, on the surface, they're a beauty and personal care company. But their real secret sauce, what makes them different, is this digital-first strategy. Think of them as a classic direct-consumer brand, or D2C. That means they pretty much skip the big retail stores and sell straight to you.
And this chart right here, it just shows you how serious they are about that model. I mean, look at this. Last year, almost 96% of their sales came directly from their own website. That's huge. It gives them complete control over the customer experience, not to mention all that valuable data. They're not just renting a spot on a shelf. They've built their own superhighway straight to their customers.
Okay, so you've got this D2C model. You've got this direct connection with customers. How does that turn into an exciting investment story? Well, that brings us to the bull case. This is the positive spin, the narrative that gets people really excited and ready to invest on day one.
And the story really starts with a number that just makes you go, wow. 532%. That's their revenue growth in the 2024 financial year. That is not just growth, people. That's explosive, what is happening kind of growth. It's a huge signal that their product is absolutely resonating with the market.
But you have to ask, right? Can a company keep that up? Is that sustainable? Well, this next number suggests that maybe it is. The very next year, almost a third of all their orders came from repeat customers. And that is the holy grail. It means they're not just a one-hit wonder, they're actually building a loyal fan base.
And you can see here, this isn't just a fluke. Look at this trend line. The percentage of repeat customers is just climbing. Steadily, impressively, year after year. To an investor, that's a beautiful sight. It screams strong brand and sticky product.
And here's where the whole bull case really comes together in one neat package. In just a couple of years, revenue and profits just went through the roof. But honestly, the most impressive part for me? Look at that debt-to-equity ratio. They went from being swamped in debt to being completely debt-free. That's an incredible story of insane growth combined with smart financial management.
Okay, so that all sounds pretty amazing, right? But you know what they say? If it sounds too good to be true, well, every great story has a flip side. And our job, as smart analysts, is to look under the hood. So, welcome to the bear case. These are the risks you're not going to find in the flashy headlines, but they are buried in the fine print.
And the company itself has to list its own risks in its IPO filings. We've pulled out the top 5 that really jumped out at us, and these aren't small things. They touch on everything from how their products are made to what they sell, all the way to the actual cash in their bank account.
And this is a biggie, maybe the biggest risk of all. RAVELCARE doesn't actually make anything. They outsource 100% of their manufacturing to a single third-party company. Just think about that for a second. What happens if that one supplier jacks up their prices, or has a fire at their factory, or, even worse, decides to work with RAVELCARE's biggest competitor? It's a massive, massive vulnerability.
Next up, we have what's called product concentration risk. Basically, even though they sell a few different things, their business is all about hair care. I mean, over 95% of their revenue comes from that one category. So if a new trend takes over, or a competitor launches the next big thing, poof, almost all their revenue is in danger. It's the classic case of having all your eggs in one basket.
Okay, now this chart shows something really interesting, and maybe a little worrying. It's their cash flow. You can see that after a couple of years of generating positive cash, last year it went negative. So even though they were profitable on paper, their actual business operations were burning through more cash than they were bringing in. For an analyst, that is a huge red flag.
And finally, let's go back to that insane growth number we saw earlier. Remember the 532% jump? Well, the year after that, growth slowed way down to just 13%. Now, 13% is still growth, but the big question you have to ask is, was that crazy hypergrowth just a one-time thing? Is the rocket ship already running out of fuel?
So, you've got this exciting growth story on one hand and some pretty serious risks on the other. So why go public now? Well, at its core, an IPO is all about raising cash. So let's follow the money and see what it tells us about their plans for the future.
Now, RAVELCARE's IPO is what's called a fresh issue. All that means is that 100% of the money they raise is going straight into the company's bank account to help it grow. And this is really important. The founders aren't selling any of their own shares. That's a huge vote of confidence. They're not just trying to cash out. They're betting on the future.
So what are they going to do with all this new cash? Well, a big chunk is going right back into marketing to keep that growth engine humming. But look at the second biggest piece of the pie, a new factory. Now this is a game changer. Remember that massive risk we talked about, their dependency on that one supplier? Well, they're using this IPO money to attack that problem head-on by building their own manufacturing. That's a really smart move.
All right, so we've looked at the good, the bad, and the plan for the future. You'd think we'd be ready for a verdict, right? Buy or sell? Well, not so fast. There's actually one final, really important piece of the puzzle that's still missing.
And here it is, a direct quote from their own paperwork. There are no other public companies in India that are a similar size in their industry. And that makes figuring out a fair price evaluation incredibly tricky. I mean, how do you know if you're getting a good deal when there's literally nothing to compare it to? So let's just lay it all out, side by side on a final scorecard. In the pros column, you've got insane growth, super loyal customers, and zero debt. That's awesome. But in the cons column, you've got this terrifying dependency on one manufacturer, you're burning cash, and that rocket ship growth is already slowing down. It's the perfect textbook definition of a high-risk, high-reward situation.
And that leaves us with the final, and maybe most important question. We've done the analysis. We've looked at the story, the numbers, the risks, but the analysis itself never gives you the final answer. All it does is lead you to the real question, the one every investor has to answer for themselves. At what price does a high-risk gamble like this turn into a smart investment? And that ultimately is a question only you can answer.